Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the show. Hopefully, you guys are rock and rolling out there. And if you're like me, like many folks out there, you've got shit piling up everywhere. You got your toys, your garage, your extra bedrooms. Sometimes I want to pull my hair out on the different crap that we have here. But as you get going and collect things and add more toys, you need a place to put it. And one of our most requested content is going to be solved today when we've got two rock stars in the storage space who are doing amazing jobs and revolutionizing the whole storage space industry out there. Now, who am I talking about? I'm talking about Jim and Joel from Storage Caves, who are going to take the whole idea of the man cave or the she shed to whole new levels. Guys, what's going on? How y'all doing today?
Hey, Scott.
What's up, Scott? Good to see you. I'm
Good to
not
see
sure
you
about, I'm
too.
not sure about the hat. We're Dodger fans out here, but that's okay.
Well,
We
well,
won't
it's
hold you.
okay. The Dodgers are still in the playoffs. I just came
Uh,
back from Boston. I am not a Dodger fan because I'm a bigger Giants fan, but cannot root against Freddie Freeman. You know what I mean? After
yeah,
the
that's
series
why
he
I'm,
had
I'm
last
wearing my
year.
blue. I got my
Yeah.
blue on. So
So what the great thing that you guys come from the distress space, the note investing space, obviously background of that for a while. You want to dive into the kind of guys' background before we dive into the new storage cave stuff that
yeah,
everybody needs to stick
sure,
around?
sure. I was the founder of a company called Summerlin Asset Management, and we opened up in 2009. And our business model was to purchase defaulted, both subperforming and non-performing first deeds of trust, collateralized by residential real estate. We did it all over the country. We were buying from Bayview and BlackRock and all the big fellas, and had a good run for about 6 or 7 years. And that's kind of our history. And then we got into the storage business.
Very nice. Joel?
Well, as you know, spent a lot of time looking at everything from, how do you best plan utilize, how do you scale your note business to dealing with servicing and all of the anomalies that take place in that. And, about a year and a half ago, Jim, and I worked on a previous project in the distress space. He called me and said, "Hey, I want to talk to you about storage." And I was like, I always was intrigued by storage, but quite frankly, really never had the nuts and the bolts. And Jim was able to break it down and explain it and talk about storage caves and how it's a paradigm shifting premise. And I was like, I am in, because as the ever-changing landscape, I mean, it's kind of like you've heard me use the expression, the Annie Hall thing. My aunt, is Annie Hall was a movie, and basically they talk about having a dead shark. A shark has to constantly be evolving, and we don't want a dead shark. And that's one of the things that when Jim approached me about this, I was like, this is next level. This is taking the 5x5s, the 5x10s, and just taking it to a whole different level of consumers, but also at the same time, it's a different opportunity. And as we approach, more uncertain economic times, we don't know good, we don't know bad, we just don't know. This is a way in which, from an investor standpoint, you mitigate your exposure because it's obviously secured by real estate, and the model that Jim has come up with, and with all credit to him, the model that he's come up with is pretty appealing to investors.
Yeah. Let's talk about that model. Let's definitely, because I know it's completely different than your total, 20 unit aspect of things here, because I love what you guys are doing. So Jim, how's this different? What's the
Well,
model?
yeah, I mean, we're ground up developers of large bay storage garages, and these garages are used for RVs, boats, cars. We're getting a lot of demand from business inventory owners, so people that own an Amazon business or a Shopify business. And then we're getting a lot of demand from contractors, from HVAC companies and plumbing and electrical. If you can imagine all the expensive equipment that needs to be stored and secured in garages, they demand a single story drive up garage. So to further answer your question, the model also incorporates creating a condo map and turning these garages into a condo, allowing the consumer to either purchase the garage or lease the garage. And then on top of that, kind of the sexy part of the model is that all we have to do is sell 35 to 40% of the garages, and our senior debt is paid off. So investors and financiers love that part of it. And so that's the model.
I love it because yes, building storage units is a lot cheaper than buying a multifamily or building a single family home in a lot of cases there when you look at the ratios and the numbers and stuff like that. You guys are doing these on not just like a 10-year, you're doing these on a pretty good size level. What's kind of square footage are you guys building these on?
Yeah, I mean, our sweet spot is to purchase between 6 and 10 acres, and we will build. I think our smallest development is 87,000 net rentable square feet, and our largest one is 188,000 square feet. And on the latter, we will do that in 2 phases.
Very nice.
Yeah.
Now, what markets are you guys targeting?
So when I founded the company in 2023, the first market that we wanted to build a brand in was Charlotte, North Carolina. That's the epicenter of the car enthusiast capital of the country. And then, I've been all over the country. I've been to Boston, New York, Miami, all throughout Texas, but I had never really spent a lot of time on the ground in Charlotte. And there's a lake there called Lake Norman. It's right there, like 20 miles north of Charlotte. When I went out there, I went boating with some colleagues and some partners, and I couldn't believe it. I got off this massive lake, and within 7 or 8 miles, we were within the population of 1 million people within 8 miles, and I'm not used to seeing that in Southern California. So we are building in Concord, North Carolina, which is next to the Charlotte Motor Speedway, and we're building adjacent to Lake Norman on the west shore of the lake in a town called Denver, North Carolina. Everyone thinks of Denver, Colorado, but there is a Denver, North Carolina. And then actually our very first development is in the Atlanta market. And we are basically receiving certificate of occupancy. Our address is 6034 Lanier Islands Parkway. You guys should look at that on Google Earth. Phenomenal location, right next to Lake Lanier. And Lake Lanier is the #1 recreating lake for the entire Atlanta market. Only sits 30 miles north of downtown Atlanta, where there's 5 million people there. So we go into locations. We've got a discipline at our company. My family office, we've got to be the guarantors on the loan. So we pass on good sites all the time, and we wait for the very best, just like great situations. And so that's a great play there in Atlanta. And then finally, we are coming out of the ground on 3 sites in the Dallas-Fort Worth market. We're in Forney, Texas, Chapel Creek, which is over by Fort Worth. And then we're also in Denton, Texas. And then we're in escrow in 2 other cities that we're under NDA. I can't tell you what other cities, but we call that the Big Three. So Charlotte, Atlanta, and Dallas is where we plan to build a major brand for storage caves.
Yeah, I definitely been to Charlotte a few times, and you're talking about Lake Norman's where all the guys from NASCAR live on that lake for the most part. Plenty of toys out there, big RV stuff like that. And Dallas, I just came back from an event in Dallas where they're talking the need for light industrial warehouse space stuff like that is at 140% of what they actually have right now in a lot of cases. So makes for an opportunity. I think you're walking in perfect storm for it, right?
I've got a funny story for you about Dallas. I'll say it really quick. My daughter got married out there a year ago, in October 2024. I'm getting ready for her wedding. I walk outside and I see this beautiful Mercedes-Benz with all these dings all over the hood and all over the roof. And I think, oh, that car got vandalized. And then I said, well, wait a minute, I'm not in California anymore. Those are damage from hailstorm, right? And right then and there, I'm like, oh my gosh. So I go to my daughter's wedding. We had a great weekend, had a great time. I get back to the office and I just start going crazy with all of our partners, employees here. Joel remembers it. I said, guys, we're going into Dallas. Call the realtors. Let's fly out there, get the civil engineers going. And so today, yeah, we've got 5 locations that we're ready to roll on. So
nice.
yeah.
How long does it take to build one of these from the ground up? The time frame?
Yeah, great question. It takes about 12 months. Probably 3 months of pre-development work, and then 12 months to construct. A lot of it's flat work. We're building light steel empty garages, but what's important is the topography and grading it, and we pour a lot of concrete. If we're going to build 140,000 square feet and have 50-foot drive aisles, you're going to have acres of concrete. So a lot of our expenses, a lot of our time is spent on the flat work, but yeah, that's the answer. Typically 12 months.
Mm-hmm. On your existing ones, I'm sure you've probably had a pretty quick ramp up of those things getting leased up or purchased up. And what kind of mixture are you seeing between buying and leasing? I'm sure it varies from location to location, but do you have any kind of numbers that you're seeing on a regular basis?
Sure.
Historical data tells us that about 60 to 70% of the garages will end up being sold, and about 30 to 40 of them will end up being leased. The way we, as Jim mentioned, we just need to sell about 40% of the garages in order to extinguish the senior debt. So at that point in time, as we're in the market, then obviously the investors then start to reap the benefits of that. One of the things I think is really interesting with regard to the lease versus purchase is the fact that we've had people come to us and say, I want to buy not one car, not one garage or two garage. We have people who've approached us of buying a building because they can buy a building and they can retain and lease them out themselves. Historical numbers tell us that you get about 6% appreciation on a garage that you will own. Obviously, each market's different and things of that nature, but that's historical data will tell us that. But also at the same time, it's appealing to a wide variety. It's originally, and Jim tells a story about originally it was boat and RV. That was the target market. And then at one point in time, someone called him and was looking for 3 garages. And he was like, how many cars or boats or RVs can one person have? And the answer was 0. And the reason being is they were a large marble contractor and they were storing their slabs outside in the middle of the night. People were coming with industrial magnets and stealing them. So it kind of is a paradigm shift on the flex space side, because COVID taught us that you can conduct business from home, but you can't conduct warehousing from home. And so the flex space usually runs anywhere between 4 and say $7 a month, depending on where you're located. If you shift your business model and you're working from home, and then you can either purchase a garage from us, so now it becomes an asset, because what we do is we go in and we create a condo map, and each unit has its own APN number. So it really becomes an asset. So there, at that point in time, you can purchase the garage or you can lease the garage, and leasing is about $1,000 a month, or you can purchase it. But now you've reduced your overhead because you're doing all your office work from your home.
No, that totally makes sense. Yeah. And it gives the guys that need a flex space the ability to step in and rent, buy one, and then grow as they need to without having a huge capital expenditure right off the bat as they're growing too, right?
Correct.
Yeah.
Yeah.
What's your guys' biggest need right now? More locations, more funding, more buyers? I mean, maybe it's more money. I think it's probably what it is because you guys are onto a hot niche here. What is it, Jim?
Yeah, I mean, sure, we need more equity partners, so more investors that really understand the model and dig into it and understand that there's relatively low risk and really solid upside. And so, yeah, more investors would help facilitate the growth that we're experiencing.
Yeah. Where do you see this going? Are there any markets you're staying out of right now?
I mean, no, I mean, our focus, Dallas, Charlotte, and Atlanta right now are going to keep us very busy. We can probably build $500 million of our product in each one of those cities. So we're going to focus on, building our brand in those cities and picking great locations. And we'll go one by one and try to dominate those 3 markets. That's the center of our bullseye. There's a couple of outer rings here and there that will make an acquisition from time to time in a couple of strategic locations. I mean, funny enough, we're making an acquisition out at Grand Lake, Oklahoma, which is a lake I have never heard of before. I went to Google Earth and I looked at this lake and there's nothing around it. And then I zoomed in, I saw all these golf courses and tennis clubs and hotels and lakefront homes. So we're actually making a very big acquisition of a property. Actually, it's a built facility with 3.8 acres to expand out on Grand Lake. So not too far from Dallas. It's like a 4-hour drive north of Dallas. It's up in the northeastern corner of Oklahoma. I don't know if you've ever heard of it or seen.
I've heard of Grand Lake before. Yeah. 4 hours, just a small jaunt across, Oklahoma to get there, right?
Yeah, it's about an hour east of Tulsa, and it's named Grand Lake Ocherokees.
There you go.
Yeah, so yeah.
Well, the thing is, we see this growing. Like I was, joking being out in Minnesota a couple weeks ago, and we saw these all over the place, which I was like, wow, that's really makes sense. And then we see more and more of those things popping up across the state here because people need a place to store their stuff, right?
Sure.
Um, and especially when you're looking at what you're spending on a big RV too, you want to protect that asset, right?
Absolutely.
Yeah, the cost of the dynamic has changed. I mean, really, COVID changed a lot of things. And first of all, I think people said, okay, what am I going to do with my free time, and how do I, kind of be solo, singular in that pursuit. And so what they bought RVs, and they bought boats. There was a significant increase in those sales. Well, you have those prices are not bashful prices, quite honestly. A boat today is 50,000 plus. An RV is 75 or $100,000 plus. It's not a small investment, and so therefore, what you want to do is you want to protect it. So first and foremost, it's an opportunity to protect your investment. But also on the other side of the coin is that when you have a boat or you have an RV and you have a place to put it, that has been restricted even more so by the advent and the expansion of HOA communities.
Mhm.
Just to give some information on just Georgia, 33% of all communities in the state of Georgia are HOA communities. And HOA communities restrict you from storing your boats or RVs or anything like that outside in the common area. So we look at this from a wider lens, I guess, maybe than we, historically you might have, because we look at it, that it's an extension of your home, because in essence, your boat and your RV is part of your family and what you do. Classic cars, if you're a collector or something of that nature. So it's an extension, but also at the same time, it serves a function for businesses. As we talked about, in storing your air conditioning companies have to buy a lot of materials prior to getting a job. They have to put them somewhere. Or marble slab contractors, staging companies for realtors,
Like for furniture staging.
furniture.
Yeah.
So there's a wide variety of uses. Utilitarian is not the right word for it, but it's very functional for a variety of different purposes. And we make it accessible from a dollars and cents perspective.
Yeah. You guys also mentioned when we last talked that you were also looking at if we saw anything that was distressed out there in the self-storage space there. How much work do you need to do to an existing storage facility? It's maybe just a normal 5x10s, 10x10s. Are you looking for something to go in and either kind of bulldoze and rebuild up, or stuff that's already got some of that stuff available? What are you looking for in something like that?
Yeah, I mean, not necessarily. I mean, we're not really, there's really nothing in our asset class that's distressed. It's much to the contrary right now. There's some mini storage assets that where you're seeing compression and cap rates and whatnot. But we're seeing a huge paradigm shift away from mini storage and into our type of storage garage. The mini storage client typically lives in an apartment, and so there's bad debt issues with some of those clients, and sometimes occupancy can drop off based on the economics of that individual. But what's driving our growth is really the fact that we thought this was about boat and RV and car storage. And I mean, the demand we're getting from business flex and business inventory is just almost insatiable at this point. And so now, now that we realize the consumer is probably triple the size of what we thought it was, I mean, that's mitigating our risk. And then obviously the condo model further mitigates our risk because we don't have to worry about a slow lease up, because if we sell 35% of our garages, we're debt free. And so that's we're not really, there's really nothing distressed. It's actually much to the contrary. We've got people that are begging online, like we said on LinkedIn. People are dying to find light industrial land where they can build this product. We've got a little bit of a different model where we're not necessarily behind the herd. We're not necessarily looking for light industrial land. We're looking for land that we can rezone, and we'll scratch the surface and talk to the city for a week or two. And if they give us a strong indication that they're going to support our project, then we'll get under contract and wait 2 or 3 months to get it rezoned. And while we're doing that, we'll do all of our pre-development work and our design and all that. So yeah.
Have you run into some cities that have been a pain in the ass?
If we run into them, we run away.
Yeah.
I wanted to throw.
Yeah,
Is there any cities here that you've talked to that are pain in the asses? I imagine
there
maybe
were.
like Austin might be, but pain in the ass to deal with.
I don't want to name any cities that might get in trouble, but I will tell you that we were in escrow on 3 sites in the Atlanta, Georgia market, and we backed out because the city was like, we don't know this neighbor, that neighbor, and like, okay, let's go to the next city. And sure enough, we're in Alpharetta, and Alpharetta, they get it. The neighbors get it. The neighbors want it. The city wants it. And so, yeah, we have to be patient and do our political work on the ground and let them know, hey, this is single story. We're not going to have these orange or red metal roll up doors. This is luxury storage. The consumer is a higher end consumer, and once they realize that, and once they look at our prototype, then they're very accommodating to what we're going to build.
That's awesome. I love it. Pain city that we know cities can definitely be pain in the ass in different areas out there, but you go where people want you to be, and that's a beautiful thing out
Yes,
there.
sir. Yeah.
When you are talking about, I'm sure you guys have done some comparison of what it costs for you guys to rent to a company that's looking for storage, light industrial stuff like versus somebody buying a warehouse. What's kind of the difference in costs that you see, or what am I trying? How am I trying to ask this question?
Yeah, no. The average rate, Scott, is about $1.20 or $1.30 per foot to lease. And pursuant to what Joel had mentioned earlier, COVID changed everything,
Yeah.
right? And so people went home to work during COVID, but they went back to their garage for logistics and distribution. And so Joel's right. In most cities, you're going to pay a minimum of $5,000 for business flex and all the way up to $10,000 a month, depending on where you're at. And with our solution, you're going to pay $1,100 for the garage, and then you could work from home, right? So the average, to answer your question, is about $1.20 a foot
Okay.
if you want to lease.
Right, that makes sense. Now, I pulled up, I loved what I saw on the website here. I was like, oh, there's definitely some flex space on here. Because you think of somebody putting their RV, they're parking their RV and they don't have a lot of room, but you've got, I love this, the flexible storage garage condominiums here with a mixture of toys, boats, and everything in there for you, huh?
Yeah, yes, sir. Yeah, that's a big, it's a 22 by 55. That's our building A out at Beaufort. That's a big one. Our bread and butter is a 15-foot wide by 50-foot deep garage, a big rectangle basically. And people do all sorts of things with that. They'll use half of it for traditional storage, and maybe in the back they'll put up a TV and a couch, maybe a billiards table. They'll watch NFL or NASCAR, the Masters. And then, yeah, so people do all sorts of things to custom. We say to customize your cave.
You could almost live in the cave if you
Uh,
wanted to.
But no, our CCNR says no, you can't. No, you're not. You're not. It wouldn't surprise me if someone slept over in their cave, but you're not supposed to live there.
Right.
No,
Rough night at home, maybe.
I was cracking up as a couple guys on TikTok were talking about how they got evicted and they went and rented a 5 by 10 and were living behind a wall.
Yeah.
Storage not going to work here.
You know what's crazy, Scott, is we're also getting about 5% of our sales are just coming from local people that live in the neighborhood that just want to buy garages and rent them out so they can just get passive cash flows. So
That's a great way, kind of like the instead of the Airbnb or the rental arbitrage, the self storage arbitrage, then, huh?
yeah. So, we're just looking for more investors to facilitate the growth. Our investors get preferred equity. We take common equity, so they're ahead of us, which further insulates and protects their capital. We give them an 8% preferred rate of return on top of their preferred equity, and then we split all profits 50-50 with our clients. So our investors are doing very well, and we're looking for more as we expand into the cities that we talked about.
Sure. Now, what kind of everybody always asks what's the minimum amount, but what kind of investment amounts are you looking for? 100K to start off with, quarter million, 50K?
No, I mean the minimum's 100,000. I mean, in reality, we try to push the minimum to 200,000 because this is not the stock market. It's not cryptocurrency. It's real estate. It's really hard for us to buy land and build something that ends up being worth less than what we have into it. And especially in storage, if there's a lot of third-party reports whether it be Marcus and Millichap, Cushman and Wakefield. They studied what happened during the last recession in '09, and there was only one asset class within real estate that actually appreciated in value. That was self-storage. And the reason for that is as there's more movement that's happening in the economy, if people are moving up, they're moving down, they're moving out of state, the benefactor of movement is self-storage. But we do not build on a location unless the location can handle 5 times the number of garages we're going to build. So we'll build about 150 units, which is a safe bet for us. Watch them absorb, watch them sell, and then go buy more land and build. So we're pretty conservative in the areas that we build in.
Yeah, no, it makes a lot of sense there for you because there are areas across the country have been oversaturated, obviously, and you see where not everybody's doing well because they're not hitting their numbers or what they expected to. So that's bravo to you guys doing that. What's the best way for those that are listening that are looking to put some money to work? And I'm obviously going to use their self-directed IRA because we got a lot of IRA investors out there too. Best way for them to reach out to you, to contact you, to talk about investing.
Yeah, I mean, they can go right to our website and call us. Our phone number is on storagecaves.com. They can fill out an inquiry sheet, and they can hit submit, and we'll get that here at our corporate office. We just expanded our corporate office in Orange, California. We've got a satellite office in Atlanta, Georgia as well. But yeah, reach out to us on our website, call us, or email us. Either way, we're easily reachable.
Yeah, I'll put the contact information there below as well for everybody. And then I'm sure you've got a prospectus that you send out to folks as well too for them to take a look at, correct?
Yes, sir. Absolutely. Yeah.
Awesome. Now, what's the question I'm not asking, Jim or Joel? What's something that I'm leaving out here that everybody should know?
That's a good question. What's the question that you're leaving out? That's interesting.
Maybe ask us, what's your plan over the next 5 years? You've got a good chunk. When you look at your locations here, you can see Buford, South Fort Mill, Concord, and you're of course building a couple in Texas. Say 5 years from now, how many are you looking to have in the next 5 years?
Yeah, I mean, we talked about 8 to 10 locations per year. The type of growth that we want to facilitate is managed. There's some people out there that are trying to build 20, 30 locations a year. And I don't know, the corporate culture here at Storage Caves is we want managed growth. We don't want to over embellish what we're going to do. We want to over promise. I'm sorry. Under promise
and over deliver.
and over deliver. Yeah. So we want moderate growth, to be honest with you. And I think to go back to your question, what aren't we covering is, people ask about, costs. And when you look at this on a spreadsheet, it's really interesting because we're building empty garages. Our variance is only like 5%. And they're like, how could that only be, 5%? And the reality is that, we're pouring a lot of concrete, and the concrete per, cubic yard is a pretty fixed amount. We erected with light steel, we hang garage doors, we have 100 amps of electricity in the garages. And so, we've only got like 7 subcontractors, which really, mitigates risk from a supply chain perspective. Like if you're building we have a ton of multifamily guys coming over to us right now because they're tired of finishing off faucets and fixtures and kitchens and countertops and light fixtures and all these different things. And the timeline to finish is like 4 years, and interest rates are a little bit higher. And so that tends to sting them a little bit. And so, and then also, if you're looking to go purchase multifamily, we had a guy telling us that like he can't even facilitate a buy and sell because the seller only wants to sell at a certain price, but then the buyer looks at this and says, "I'm only going to make 5.5% on my money, and I'm going to bring in all these headaches from toilets that overflow, and there's plumbing problems and electrical problems." Well, in these types of garages, they're cash cows, to be honest with you. When you take the percentage of rent by the cost per unit that it costs us, these garages spit out about 27% more cash than anything that we've ever seen in multifamily. So
yeah, there's all sorts of headaches in multifamily. I got a buddy, it's in 20 different syndications and 19 of them aren't paying.
Seriously, yeah.
It's a rough spot. A lot of blood in the stream over there. But like you said, you're building an asset. It has nothing but appreciation from day one with the improvements. you're at such a low debt to income or debt to valuation strategy that you're paying off that debt in such a good position, and then and cranking out cash flow as cash cows. So it's a great investment for you guys out there looking to diversify or dive into something that I think makes a little bit more sense. Because I think, believe it or not, with affordable housing being difficult and people not being able to afford stuff, they're looking for a place to put their stuff or put their toys or get away from the spouse in their own man cave or female cave, right?
True. Yeah. That's correct. That's a fact. I mean, I've been married for 33 years, so I better not comment on that one.
You're in a performing marriage there versus non-performing.
Yeah, yes, sir.
Can't wait to spend more time.
Yeah, exactly. Honey, you want to come decorate my man cave? Let's do it.
Yeah.
That's awesome, guys. Well, I want to say thanks for coming on here. Once again, guys out there, check them out. Storagecaves.com is a website. Jim and Joel, you got questions, pick up the phone, give them a phone call, shoot them an email. They both know what they're doing. They've been doing this for a while now. And like I said, you're on a cusp of an opportunity that's really got no place to go except up in a lot of cases. So, Jim, thanks so much for coming on. Joel, thanks for coming on, guys. Best place is just the website to reach out to you, or
yes,
other
sir.
places?
Yes, sir. Call us, go to the website. Yep.
Awesome. Good stuff. Thanks, guys. All right, guys, that's going to wrap up for this episode. Make sure to check them out, storagecaves.com. You got some money to put to work, your IRA, money sitting aside, you've been sitting around waiting for the perfect time. Hey, this is a perfect opportunity for you to put some money to work. That's not going to go up or not go down, go up for you there. And these guys know exactly what they're doing. Lean, mean, storage cave building machines. Well, guys, we'll see you at the top. Hey, real estate investors, this is Scott Carson. I'm known across the country as a note guy. For the past 20 years, I've been buying distressed assets, primarily non-performing notes on residential and commercial properties. And if you've ever wanted to learn how to dive in to start buying non-performing notes from banks, hedge funds, or other investors like yourself, then there's no greater place than to get the nuts and bolts, the A to Z, the 1 through 99 place to get started. It is our virtual note buying workshop. We've been teaching this class since 2010 on how to find, fund, flip non-performing notes, how to get banks to call you with deals that you can cherry pick. And no, you don't need millions. No, you don't need a lot of experience to start looking at non-performing notes. We get the lists of notes from banks, hedge funds on a regular basis, not 1 or 2 or 3 or 4, but hundreds of deals that we can evaluate and cherry pick. Whether we're looking for performing notes or non-performing notes that we can get reperforming, or non-performing notes you can foreclose and take back, whatever your niche or whatever you would like to focus on, we can help make it happen at the virtual note buying workshop. It's a 3-day class. Our next one is April 18th to the 20th. It's actually online live via Zoom. You get signed up by going to notebuyingfordummies.com. That's notebuyingfordummies.com. Day one is all about how to find these assets. How do you find asset managers? How do you find lists of people to reach out to that you don't have to spend thousands of dollars on postcards or letters that you waste money on? We don't do that. Day 2 is all about raising capital and marketing and how to create a business that feeds itself, that you can do part-time, 10 hours a week, 5 hours a week, depending on what your focus is. We'll show you a game plan to achieve deal flow coming in on autopilot versus you having to send a ton of money. And also, we'll show you how to raise capital like nobody else does. And then day 3 is all about the flip. How do we structure deals? How do we evaluate a tape to find the deals from the duds? All right. We'll show you what vendors to use. We'll give you a 200+ page manual, contracts, sample forms, all the stuff that you need to be a lean, mean note buying machine when you get wrapped up. Now, yes, this is live April 18th through the 20th online via Zoom. Get signed up today. We'll send you the replays of the previous online workshop so you can start learning, start evaluating material, and get rock and rolling. And if for some reason you don't like our class, we have a 100% money back guarantee involved with it. If at the end of the first day you don't like what we talk about, you don't think it's impactful, just let me know. We'll refund back your tuition, no questions asked. We don't want your money. We want you to become a note buyer. We want you to become a lien lord. All right. Like I said, if you're tired of dealing with toilets, tenants, and trash outs, you don't want to deal with renters, then becoming a note investor is the path for you. Everybody evolves into a note investor at some point, but there are plenty of opportunities out there. There are millions of non-performing notes that you can cherry pick. No, it's not all junk. It can be small value all the way up to $1 million homes or $1 million apartments for you. So much opportunity is taking place right now in the chaotic market that we see. And who's going to come out on top? Note investors will. So take the time, get signed up today, April 18th to 20th. Go to notebuyingfordummies.com or go to our website, weclosenotes.com, and sign up for the virtual workshop there. As always, get signed up today. We run discounts all the time. The cost of tuition is you plus your partner or spouse. So get signed up today at notebuyingfordummies.com, and we'll see you at the top.